You're listening to the What's Happening podcast with Gary Watts.
I'm here today with Mike Messier of the Messier Group. Mike and I have known each other for, I don't know how long, 45? I was going to say 50 years, but not quite 50, huh? But a long, long time. Good morning, Mike. How are you?
I'm doing great, Gary. How are you?
So to start it off today, we've been friends for a long time. Tell me how, you're in the insurance business. Tell me how you got started, where you went to school. We have to mention Iowa State, right?
We do.
But tell me how you got started and what was your thought process in school? I know you came from Illinois, but just give us a little background on yourself, would you?
You bet. My wife and I were at Iowa State at the time, got married in our junior year, and much to my chagrin, instead of continuing to have fun, I had to go out and actually make a living and try and support us. And
Bummer.
it was
Right.
a real bummer.
You had to work.
And I was having a lot of fun. And answered an ad in a newspaper in the Des Moines Register. And the ad had started out with sports-minded people, blah, blah, blah. And I thought, oh, this is great. I'll probably be selling sporting goods or something like this. I'll give this a shot and see what happens. Went to the interview, found out later that I was going to be working for the Combined Insurance Company of America.
Yeah. Who started that?
W. Clement Stone.
That's right. Yeah, he was famous. Wasn't
Very good friend of Norman Vincent Peale, high-powered, positive thinking guy, that type of thing.
Did he write a book?
He did. He wrote several books. In fact, we went, once I contracted, we went to a 2-week training school. We were basically sequestered for 2 weeks at a motel in Des Moines. And the Midtown Motor Inn, that ought to tell you what it was like.
$10 a night?
That's about right. I can tell you a lot of stories about the Midtown Motor Inn, but I won't.
Yeah, don't.
But
not during this
every
podcast.
morning was the group of us getting up in front of a mirror in a big room and screaming, "We are happy, healthy, and terrific."
Good.
And that's how we started our day. Went through 2 weeks of training, handed me a policy roll, so about double the size of a Lego pad. The policy that I was going to hand you after I sold it to you was right there to tear off.
Really?
Went out, had a canned speech, went door to door knocking on doors in Fort Dodge, Iowa.
But you've never forgot about standing in front of the mirror.
No.
And that's
never.
45, 50 years later, right? So that's interesting stuff that stuck in your head because it helped you do something. Right?
Well, that and the indoctrination. I mean, the whole idea of just, you knew I could almost, if I thought long and hard enough today, probably recite the sales pitch if I thought long enough.
Go ahead.
No, I didn't.
Come on.
Oh, no. It was a travel accident policy, little giant travel accident policies, $9 every 6 months.
Where'd you get your clients?
And we door to door.
Or you just went into Fort Dodge?
Into Fort Dodge, went into the country areas around. One of the first golf courses I played in Iowa was the 9-hole course at Dayton, Iowa.
Dayton.
Decided one day, instead of working in the morning, I was going to go play golf, and that was.
So what was your reception like when you knocked on the door?
It was interesting because at the stage that I came in, Combined had been very active, especially in the rural areas, for a long time, and you collected the premium. So in addition to going out and writing new policies, I was also collecting premium for old policies.
Oh man!
And so they were expecting you. Yeah, we wondered when you were coming around, and what you would then try to do, obviously, is sell them something new or maybe sell policies on their grandchildren. One of the things that we always discussed, one of the objectives, was to see how many policies you could write in one household. So if I walked into your house and you had 5 kids and 50 grandchildren, I did everything I could to make sure everybody had a policy.
What type of policy? Life insurance? Or?
No, it was a travel accident policy.
On your tractor? I mean,
no, it was travel as in, travel for fun, leisure travel, and that type of thing. Later, they developed a plan for sicknesses and accidents that occurred as a result of employment, so on and so forth. But
not disability. It was more of a I never heard of travel accident.
It was you know what it was a forerunner of, if I really think of it?
Disability?
No. Oh shoot. Nick Saban, the Duck.
Affleck.
Yes, that's exactly right.
Yeah.
I would say that they could have been considered a forerunner to Affleck, and because they eventually evolved into that kind of a concept.
Today, if you were running around knocking on doors, you'd be
You'd be
arrested.
shot.
Yeah, or you might be shot.
I mean, I can honestly tell you that once I became a legitimate insurance agent and actually opened an agency and that type of thing, we here in Johnson County were doing some service work for a company out of Des Moines and had to go in the rural areas face to face at that time. And I got backed into a guy's house at gunpoint south of Lone Tree.
Really?
And so for exactly that kind of a thing, because who are you? What are you doing on my property?
Right.
Blah, blah, blah. But anyway, so that's how I got started.
So you started in Fort Dodge, door knocking.
Got
How'd you
married.
get here?
Interesting story.
You're going here.
I am, Mitzi and I are living in an apartment complex, got to be friends with the manager and his wife. And one day he's talking to me and he said, I'm going to Iowa City. I'm moving to Iowa City. My dad has an insurance agency in Cedar Rapids, and they've contracted with a company out of Des Moines to work in banks in Eastern Iowa. We're going to do this, this, and this. And I said, you know what? Let's get together 6 months from now. I'll tell you what's happening in my life on the insurance side of the fence. You tell me what's happening on yours, and I'll go where you're at, or you can come back to where I'm at if we have whoever's got the better gig. Got together in 6 months. He had the far better deal. Vince and I packed up, moved to Iowa City, and the rest is history.
From where, Ames?
From Ames. Went to work for Continental Western Life at that time and an agency out of Davenport, and we were working in rural banks in Iowa, offering a product that the bankers endorsed and so on and so forth.
So you go into a bank and they give you your customers?
Yes. In fact, it was my indoctrination. I went from knocking on doors to receiving 20 leads on Monday morning of individuals that were depositors at the bank who had received a letter from the president of the bank saying, this is a good deal, talk to these people.
Was that easier?
Oh, to coin a phrase, it was like taking candy from a baby. I mean, you basically finished your presentation that it was, is $100 going to work, or would $200 be better? And you were basically discussing their monthly premium, and that's what we did.
But how did you, I got to throw this at you. I mean, that was before computers.
Yes.
Before cell phones, before texting, before faxes, how did you do it?
I had a yellow legal pad and the presentation was done on a yellow legal pad. And it was basically the old Ben Franklin close.
Pro-con.
Yep. These are the cons. These are the pros. This is what the product will do. And that was it. You got down to the end. And once you were done, it was how much money do you want to put in?
And sign a contract. And you probably had a duplicate, right?
It was duplicate. That situation, I wasn't tearing the policy off and leaving it with them. They actually had to send the paperwork in and receive a legitimate policy. So we did that for about 3 or 4 years. And then that market dried up. And I, at that point in time, decided that I was just going to open my own shop, put a shingle out, see what happened, and go from there. And the rest is history 50 years later.
How do you think, when you think back of Fort Dodge and knocking on doors and then obtaining leads from the bank, how did that help you for today as you built your career and you went through it? What did it teach you, like especially the cold calls? Because I have a similar story to that.
Well, number one, I mean, you're 21 years old. That's what I was. And you're coming face to face with people that are probably 20, 30 years your senior, a lot of them.
Right.
And you know them from nothing. I mean, you know nothing about them. They know nothing about you. And it's just, here I am. This is what I have. What do you think? I mean, that's not only talk about building social skills, whether you wanted to or not, you were forced to, because you had to know how to deal with these people, how to talk with them, how to talk in common with them. You're not going to walk into a farmer's yard and start talking politics or what's going on in industry or whatever. So you had to know the lingo. You had to know you had to do a little homework to know who you were talking to. The other thing it did is, if I didn't sell anything, we didn't eat. If I sold something, we ate. And that sounds a little more stark than it was, but I mean, we weren't eating a lot of steak, and There was a lot of macaroni and cheese in those days and that type of thing. But you know what? I mean, you either produced or you didn't get paid. Much different scenario than what we hear about today, because there were no demands that this is what I'm worth and this is what you should be paying me because I did this, this, and this. It's sell or you don't eat.
Wow. So that definitely made it probably touch a lot, probably to learn how to close, probably touch a lot about people, a lot of different kind of backgrounds, a lot of different
Yes.
kinds of stories with everybody. Were there local insurance companies like in Fort Dodge and these little towns you're around, or were there not that prevalent?
Oh, no, they
where you
were.
had a specific kind of insurance.
That's exactly right. Ours was, we were a frill. We were a fringe
Right.
type of coverage. We were an extra if you could afford it. That's what it boiled down to.
Right.
I'm trying to think of something I would compare it to today. Probably the best example would be something that's been around for a while called cancer insurance, where you can buy a policy that covers you specifically for cancer and pays for a lot of the expenses that a typical health insurance contract would not. A lot of people own them, but the people that own them are people that can afford them because I don't want to call it a luxury, but like a luxury.
Well, let's get into, so now you're here and you started with Continental Western. Is that a life insurance company?
Life insurance company out of Des Moines.
So you always were just specifically in life, or you went health? You did several different kinds of carriers, right?
When I started, probably the first 10 years of my career, I was strictly life and a little bit of disability. And then eventually evolved into the health insurance marketplace. We went from Continental Western to a company out of Des Moines, National Travelers Life, who since has merged with EMC. And National Travelers, again, had a product geared for the rural marketplace. And it was a health product that was competitive with other carriers. And I look back at that now and I think about that. At the time we did that, there were probably no fewer than, I don't know, it's just a guess, but 20, 25 carriers writing health insurance in the state of Iowa. Today there are 2.
Wow.
And
who are they?
Today it's Wellmark Blue Cross Blue Shield and Medica out of the Twin Cities.
But there were 25, so they got ate up by the big boys.
Well, they got out of it, is what basically.
There wasn't any money.
Unlike the life insurance industry, where larger carriers bought up smaller carriers, in the health insurance industry, the evolution was just one of elimination. Companies just didn't want to deal with
That's
health
interesting,
insurance.
25 to 2. So if you, just probably an odd question, but so if you had somebody approach you now and said, Mike, I want to get in the insurance business, how would you start some young person out? Let's say they're younger. Would you have them door knock? Would you have, how would you teach somebody, based on your experience of an insurance career, in life insurance, for example?
Today, it's virtually impossible for someone to do it, to start the way I started 50 years ago. Federal regulations, state regulations are such that you just don't go knocking on doors anymore. You have to be careful about who you call, how you call, when you call, if you can call at all. It's a very, very difficult industry, I think, to break into today. And I think unless you're doing it in conjunction with another area of insurance, say property and casualty as an example, maybe an affiliation with a bank, something of that nature, it just isn't, you just don't see it happening today the way it did 30, 40, 50 years ago. It's a situation where if a company wants to hire a new person today, particularly for the life insurance industry, it almost has to be a salaried position of some kind with incentives for productivity, which really kind of, unfortunately, takes some of the the hunger out of it. I mean, when you're hungry, you work, and when you're not hungry, your tendency is to not work, and so it's just not the same as it was 40
So if you had
years
to make
ago.
10 sales calls and you have no sales, you might make 11, 12, 13. You keep going. Where now, if you're salaried or whatever, you make the 10, you're done, you go home.
Well, many times, I didn't get home till 10 o'clock at night, 10:30 at night. know, depending on where we were at, where we were driving it today. I mean, you tell someone they're going to work beyond 5 o'clock in the afternoon, they look at you like you're
They
crazy.
start to shake. Let's get into life insurance a little bit. That's my favorite topic. But, we
Oh yeah, I know.
kidding,
Love
but
it. You love
insurance in general. But let's talk about life insurance, which obviously is a very important aspect of everybody's life because you are going to pass away. And and we were young once. It might be a maze with our gray hair and whatever, but we were. Let's talk about why you need life insurance, and let's talk about maybe you can go through an array of products. But let's say you're young. Why would you need life insurance? Because you're going to live forever. As a young person, you live forever. Let's talk about what happens when you add family members, have children. And then maybe at the end, maybe talk a little bit about, I'm an old man. Can I still get insurance, for example? So why don't you just give us a spiel, which I think could be interesting to the listenership of a little bit more than just I got to have life insurance.
Today, probably the biggest difference today when comparing it to 30, 40 years ago is that term insurance by far has become the prominent product in the marketplace.
What's term insurance?
Term insurance is strictly a death benefit. You're buying coverage, you're buying money, if you will, at a very low cost to provide for some need. And
over a certain period of time.
That's exactly
20
right.
years, 30 years, 10 years, whatever it is.
No cash value, no equity position. Right. You die, there's a payoff. If you don't, there isn't.
So if you have a $100,000 policy, for example, for 20 years, anytime during the 20 years, as long as you kept the premiums current, they pay a death benefit of $100,000.
That's exactly right.
Pretty simple, basic.
Very simple, very inexpensive. As an example, a 25-year-old, 30-year-old for that matter, could buy $1 million of life insurance today. And let's face it, I mean, $1 million isn't what it was 20 years ago, but $1 million is still $1 million. Yeah. And probably buy that on a 20-year level basis for $30 a month.
Do you need that if you're single?
Say that again.
You're a young person, you're single. Do you need life insurance?
Here's my take, my position, and I would emphasize these are my opinions, but it's the way I look at it. One, if you have a family, it goes without question. The need is there for the kids' education, replacement of income, so on and so forth. If you're a single person trying to decide whether you need something or not, if you have no debt, if you're basically in a reasonable financial position, you're probably asking yourself, why in the world would I buy life insurance? And seriously, probably the strongest argument is just to secure your insurability in the event that you do get married and you do have a family.
So get into insurability.
So I'm 25, I'm single, I'm healthy as a horse.
Right.
I can do anything I want, male or female. I can go buy the coverage. Nobody's going to ask a lot of questions, pay the premium. I'm good. Say we'll use a 30-year level term as an example. Right now, it's a luxury. Who am I going to leave that money to? Maybe I leave it to siblings. Maybe I leave it to a charity, whatever. But it's hard for me to justify as that individual paying the money for that coverage because what am I going to do? Well, the reason it's important is because 10 years down the road, now you're married, now you have a couple of kids, and God forbid you develop some form of cancer. Well, if you haven't purchased that policy and already have it in place, you're going to have a difficult time getting coverage. Right. And so what that single person does is they guarantee the future is what it boils down to, that they're going to have something even if their health changes and they can't get something later.
So if but you can't do that, convert that from a term policy, right?
You can, later on, you can convert a term policy to what we call permanent coverage, like a whole life policy that has equity and so on and so forth, at a much more costly, in a much more costly situation. That happens occasionally when we have a situation where someone wants to maintain some level of coverage for an indefinite period of time. And normally if there's a health issue, because you're guaranteed you can convert that with no regard for your health whatsoever. So that's a positive. If I'm healthy, I just buy another term policy. It's a little more expensive, but I buy it for another 20 years, and so on down the line.
So is there a percentage of, because kids when they're younger, they probably don't have any net worth, 25 to 30, let's say that. Is there a percentage you need 100 grand, 500 grand, 200? How do you determine a face value of a policy for younger folks?
It's interesting you ask that question because if I go back 20 or 30 years ago, we had very elaborate, sophisticated tools that we used and systems, and we'd ask 10 pages of questions to determine what a person should have, and we'd coordinate it with Social Security and on and on and on. 15 years ago, I decided, you know what? People, by and large, I don't care how sophisticated or how educated they are, like simple. And the simpler you keep it, the better. So when someone asks me that question, if it's a young person with a young family, it's basically how much of your income does your surviving spouse need for how long?
Give me an
And
example. Let's
so
say they're
let's
30
say
and they have two kids.
I'm sorry, Gary, what'd you say?
30 years old and
Okay.
two kids.
So
For
we got
example.
two 30-year-olds, two children.
Right.
What I would look at them, and let's just say for argument's sake, they're both making $100,000 a year.
Okay.
I would look at them and say, okay, you're both on equal footing. You're both providing an equal amount of money to the household. If one of you dies, what is the other one going to need in order to maintain the household? It's somewhere similar to where you're at right now. They give me the answer, 50%. So now I know we're looking at $50,000.
Okay.
And how long do you think you need that 50,000? Well, I'd need it for at least 10 years minimum.
Okay.
All right. So we want $500,000 of life insurance. Now let's talk about the kids. Are you interested in the education of those two children? Absolutely. I want to pay it 100%. Well, right now, if you send them to the University of Iowa, 4 years is going to cost you, and we'll just pick a number, say $100,000. So we need $100,000 for each kid. So you need 700, rounded up to 750. If you want, you get a break at $1 million. Your choice. And then we go from there, and that's it. And we can adjust it on a term policy. You can actually reduce the size of the contract during the term if you want to, if you need to. So if we get to a point where one of those kids is now out of college, well, I don't need that 100,000 anymore. So
Right.
maybe we adjust the policy unless there's a different need or whatever the case might be.
Do you find the younger crowd, it's hard for them to talk about life insurance? It's hard to get into that.
Actually, it's easier, I think, today than it was 20 years ago. That's just my opinion, because I get a lot of calls requesting it.
Why is that?
They know term insurance is inexpensive.
Okay.
They hear ads, whether it's on social media or the radio or television, about inexpensive life insurance to protect your family. And instead of going direct, a lot of them want a local contact. And so we'll get those calls to talk about what they can do and what it's going to cost them to do it.
So just like anything, they can go online or they can,
Oh, absolutely.
Google somebody who's good life insurance. But do you think they still need that hometown local person who can sit down with them and grind through all the aspects, right? Or not? Or is it just everybody going to
Well,
computer?
here's the way I look at it is if there's no difference in the cost, whether you go online and buy it direct or whether you come to me, then why wouldn't you want someone local that you can talk to when you have questions and issues and so on and so forth, as opposed to having to try to navigate that yourself online?
Right.
And that, I think that's probably the one misconception a lot of people have, is they think they're saving something by going direct as opposed to coming to an agent like myself. And in most cases, that's not the case.
We run into the same thing in real estate with interest rates. Well, I can go online and there's somebody in Cincinnati, Ohio that has a better rate. And I'm always going, wait a minute. These local folks are all great. We got great rates. They service the accounts. They go through the whole process in the real estate transaction with you. I've been around 45 years here. I mean, but it's amazing. I can save an eighth of a point. Well, no, you can't. But by the time you think you can, and then they show you all the costs and the points and the closing costs and the things, hidden fees that are usually in those deals, they end up better off staying home.
That and the other thing is, when you need to talk to someone,
right,
you don't want to have to sit on a telephone for 20 minutes waiting for someone to answer or try to get an email response back or whatever. It's funny. over the years and its age, the older I've gotten, the less
Oh.
tolerant I've become. And 20 years ago, I would have fought that battle. It would have been, here's why you shouldn't do that. Here's why you should come see me. Now, when someone confronts me with that, go for it. Good luck.
Yeah.
But if you need help later on, I'm still here. I'm not going to burn any bridges. Give me a call if you don't like
And
what
they
you
circle
did.
back, probably.
That's it.
So now we got younger folks, and that was a pretty simple formula to get up to $1 million or of death benefit. Let's go into in term. I think we get it's specific to length of time, 10, 15, 20, 30 years, whatnot. Now let's talk a little bit about whole life because you don't hear that word thrown around a lot. And I think, is it still called whole life?
It is.
How about that? I got one right. That's cool.
It is.
Anyway, to talk to a little bit about as a young person or even middle-aged or whatever, the difference between term and whole life and what would be the benefit to have whole life.
What I always used to do when I had a young couple come in, we'd sell the bulk of the coverage in term insurance. That would be our recommendation. But then I'd try to get each of them to purchase a small whole life policy, 25,000, 50,000. And the point of that was they're probably going to pay the same for that 25 or 50,000 as they paid for $500,000 or $1 million of term insurance. But that policy builds equity. And
What's that mean? Tell us what that means.
I'll try and keep this simple, but
Yeah, please.
the best option would be what we call a participating whole life policy. And all that means is the policy pays dividends. And what those dividends are, they are a return of excess premiums.
So if you pay $100 a month, 60 that goes toward paying for the life insurance and 40 is invested. Is that the way to kind of look at it?
Not even that, Gary. It's what it is this is if you're a 25-year-old and you buy that policy from our company, our greatest risk is the early years of you owning that policy because you haven't given us a lot of money and we're giving you a lot back. As you age and as you live longer, it becomes less and less costly for us because you've given us more money. You paid more premiums. So what we start to do is pay some of that back in the form of a dividend. It's not a lot of money, but it's a little bit. And that dividend can be used as a cash account, or it can be used to offset your premium, or it can be used to buy additional coverage. You've got options.
And you have guaranteed insurability.
Exactly.
And that might be another reason why to do it.
Absolutely. And over time, while anyone could argue that there are better investments, over time, with those dividends and the built-in cash value that builds inside that policy, that contract becomes a fairly decent fixed income, if you will, that's using the term very loosely, type of investment, almost comparable to, say, a CD or something along that line, because you have this pool of money that can be utilized in an emergency if you need it. And so we always did that in an effort to, it's always hard starting, and keep in mind, 30 years ago, if a couple had a household income of $40,000 or $50,000, that was a big deal. Yeah. Today, if they don't have a household income of $250,000, it's a much different world.
Right.
But this was also a way to create a forced savings account for them because we knew that 10 or 15 years down the road, thereuld be a nice chunk.
So how do you take it out? Let's say that 20 years from now, you're buying a house, you want to tap that a little bit. Can you just pull it out?
You actually have, on the dividend side, you have two cash accounts. You have your guaranteed cash value, and then you have a dividend account with cash value also. The dividend account can be accessed just as you described. The cash value is a borrowing. You actually borrow money from yourself.
At what rate?
You're basically borrowing at an established rate in the contract, normally something nominal, and you can either pay that back or don't pay it back. If you don't pay it back, when you die, it's simply deducted from the death benefit at the time of your death.
I think a lot of people, I know they're listening, they probably don't realize all the benefits of and the different products in life insurance. They think I'm just guaranteeing if I die, I get so much for the spouse or whatever, the kids, whatnot. But what they're not paying attention to, or I never did, is guys, there's some real value that if you can set aside X, you got another little asset like an annuity or something you can tap. And another thing that's kind of interesting, I don't know if you want to talk about this, is, when you get old, let's say you say, I don't need life insurance anymore because I have enough assets. Can you sell a life insurance policy?
Absolutely.
Talk about that, because people never hear that. They don't talk about it. Let's say that, let's say the husband died 5 years ago and his widow's there and she's got a $5 million policy.
She does.
She does. Yeah. I mean, you see it the other way.
Well,
in other words, she doesn't need the money. He has already passed and left. So for her estate planning, and let's say she wants to buy a house in Florida or something, she can sell that policy.
Oh yeah. There's so many. The life insurance industry has just exploded in terms of concepts and usages. I'll point out one. I'm not particularly a big proponent of them, but during the AIDS crisis, there's a concept that developed called a viatical settlement.
Okay. You spell that? No,
I won't, but
don't.
it's just a viatical settlement. And here's what it was. Insurance companies, you're an AIDS patient. As you know, during the AIDS crisis initially, I mean, anyone diagnosed was basically a terminal patient. It was just
Right.
a matter of time. So I'm sitting on a life insurance policy. Whatever, it makes no difference how much it is. I have a life insurance policy. I know I'm going to die, but I have no one to give it to, and I've got a limited time to live. What if I could get that? What if I could take advantage of that? Well, these companies swooped in. They would offer you a certain percentage
What,
of the
50
death.
cents, 60 cents?
That's probably, at that time, it might have even been as little as 30 or 40
Really?
cents on the dollar.
But they give you cash, and then
But they give
own
you
the policy.
cash, and in exchange, they become the beneficiary of your life insurance
Right.
policy. Okay. And there's a lot, it's a lot more detailed than that, but that's the basic concept. And that market has grown over time.
Who buys those?
To
Other life insurance companies?
other life insurance
Really?
companies. There are other companies that are not necessarily directly tied to the life insurance industry that do it. It's
something you don't hear about a lot, but it's for the older crowd here.
It is.
There could be an option if there's something that you want to do, or set up your estate planning or whatever.
Particularly if it's someone who has no heirs,
Right.
Even be it a couple or whatever, who's financially stable, they have no heirs. Maybe it's a way to do it. Actual term policies. There are several companies that offer in their term contracts now the opportunity to access some of your money, your death benefit, before you die, if you are determined to be terminally ill, and some other circumstances that do allow some access in certain situations like that. But going back to older individuals, it's interesting because the situations that merit the use of life insurance, and it can be very effective, are many. But a couple of them that I've used with people, say 65 and older, take a farm operation or a family business, and I have 3 or 4 kids, but I only have one of those kids who's either going to take over the family farm or the family business, but I want to treat everybody equally. Well, how do I compensate those, what we called off-farm heirs, equally if they're not going to be involved in the business? Well, what we do is we value the business, and we determine what each child would have gotten as a share of the business, and we buy life insurance policies to compensate the off-farm heirs. The only issue is the owner, the father, the mother, whatever the case might be, has to be insurable in order to do that. But it's one of those examples of using life insurance beyond just providing for basic family needs. Estate taxes. That used to be a very big market for those of us who are in the life insurance industry. Back when the standard exemption on the state was $1 million.
Now
Well,
it's
now,
25 million.
yeah, it's gotten to the point where there are occasions where it still is a very useful product. And what we use in those situations is something called second to die, where two people buy one policy and the policy pays off when the second one dies, because that's when the tax is going to be due. So those types of situations lend themselves to working with people, in the older age brackets, again, if they're healthy enough to be able to do those things.
Well, I think it's a classic. Just sitting here talking, I'm going to get into medical insurance next, which is my favorite topic. But I think it shows you that you get a good insurance agent and spend time with them, because it's a huge asset and a huge tool to understand all the dynamics of it, as opposed to I just need to cover myself for $100,000 or whatever you're doing, or
Well,
$1 million.
it's the example of the family business or the family farm. It's thinking outside the box.
Right.
And you may have the best attorney on earth and the best accountant on earth, but a lot of times they don't think outside the box.
Right.
So
It's just a nice tool. So let's get into medical insurance. So let's start out with what's the difference today? I know there was Obamacare. You might want to get into that, or what we went through a few years back. To me, as an old guy here, it used to be Blue Cross Blue Shield. You had your card, everybody's happy, and it was a great company. It still is, and everything's covered. So what's changed? Or just go through some health insurance thoughts here while we're talking about, because everybody needs health insurance.
as I mentioned earlier, pre-Affordable Care Act, or as you refer to it, Obamacare, we had what I would call, for lack of a better term, open access. We had several carriers offering health insurance products, a lot of variety, a lot of availability. You had choices. And it was all dictated by your health, your family size, age, so on and so forth. Once the ACA was introduced, the marketplace changed dramatically. And these, again, are my opinions, but I'm going to tell you what I think. It created an ideal situation for people at the time, in particular, who were at 250% of the poverty level or below, and some benefit for people who were between the 250 and 400% level of the poverty.
What's that mean, 250%?
What that means is this. Let's say that the poverty level, I think right now in the United States for a single person, it's around $12,000.
Okay.
So 250% of 12,000 is going to be in the $28,000 to $30,000 range.
Okay.
So if you had an income of $28,000 to $30,000, you went to the marketplace, as they referred to it, and you looked at policies, and you could buy very, very good health insurance and probably pay little or nothing for it, because you were receiving subsidies, which is what that whole program was built on, is accessibility and subsidies to help you pay for it. Once you went from 250% to 400%, so now we're talking $48,000 for a single person, you still receive some benefits, but you were paying a reasonable amount of the cost of that health insurance. Great for that group. But as soon as you got at 400% of the poverty level or above, so now I'm at, say, 50,000 of income or above, my access was still there. I could still look at all the same policies that other person was looking at, but I received no financial benefit to purchase.
The benefit was from who?
The benefit was from the federal government. That's who's subsidizing it.
Right. So people paying higher premiums or made more money were subsidizing the lower income folks.
And so what you had happening is you have one person here with an income of 30,000, one person here with an income of 70,000, looking at the same health insurance contract. The person at $30,000 is maybe paying, we'll just use a number, $25 a month. The person at 70,000 is paying $500 a month. And you had that kind of disparity, which the program was intended to do, is intended to acknowledge income levels and who can afford what.
And the goal there was to have everybody insured.
That's exactly right.
Which I think is a noble goal. I think that's everybody.
It's a noble goal, but in the realm of insurance, it's
difficult.
I
to
don't want to say
administer?
it's. I would call it. It's an unattainable goal, and I'll tell you why. From my perspective, imagine this: you're going out to buy car insurance, and you go in and you see your car insurance agent, and I'm sitting across the table. We're both there at the same time. I've had 3 accidents, 2 Omvis,
Oh,
and my car looks like it's been through a demolition derby.
Yeah.
You're pristine. You haven't had a ticket since the day you began driving. You've been driving for 25 years. Last year you paid $300 and I paid $1,000. This year the agent sits us down and said, guess what? You're each going to pay $500 this year. I'm pleased as punch. My coverage went down by, 50 by 100%.
Yeah.
You're madder than heck because your coverage just went up.
Yeah.
Well, the government decided that I shouldn't be penalized for all my problems. So you're going to help pay for my car insurance. That's exactly what the Affordable Care Act did to health insurance.
So prior to that,
prior to the ACA, when you applied for a health insurance policy, if your health was bad, if you were 5'6" tall and weighed 300 pounds and had heart disease and circulatory problems and so on and so forth, I, as an insurance company, had the right or the
Turn 'em down.
flexibility to either charge you more,
right.
tell you I wouldn't cover those conditions, or not cover you at all. So the extreme risks that I knew were going to impact my overall book of business, I could deal with. After the ACA, I could no longer do that. If I'm going to play in the game, I have to accept everybody. So now, using that auto insurance analogy, I've got to take everybody,
So
including the guy.
Without the Affordable Care Act, you'd have people uninsured
That's exactly
because they
right.
couldn't afford it or they had pre-existing
That's
conditions.
right.
So that's not right either.
No, it's a noble,
Right.
it's a noble proposition
Right.
to insure everybody. It's an unrealistic proposition to attempt to do it under the financial structure that they're attempting to do it.
So let's talk about today. What are the differences today in like health plans, companies? What are you seeing in the health? How many companies do you say there's just 2?
Right now in the state of Iowa, that's the other thing. The
And why
AC
is that only 2 in Iowa? Is there
They're
more?
the only
now?
ones who want to play the game. The one thing the Affordable Care Act did not tell the insurance industry is you have to sell health insurance. So, and interestingly enough, Wellmark Blue Cross Blue Shield writes roughly 75 to 80 cents of every dollar of health insurance from cradle to grave in the state of Iowa. They did not play in the ACA the first couple of years because they said, you're not going to tell us we have to sell health insurance if we don't want to. We can sell it to our people who are over 65. We can sell it to groups. We can do that. We're not going to get in the
So
individual
who covered
market.
that first 2 years? What company?
Pardon me?
What company covered the first 2
Medica
years?
out of Minneapolis has been in the market in Iowa since the day it was introduced. They've been the only carrier who was there. And what basically has happened is companies have just said, we're just not going to play. Well, Wellmark did eventually get in. They've been in now for, I think 2023 might be the 3rd year that they've been playing in the marketplace. And so now they become a factor again in that individual sector. But if you think about it, you only have 2 choices. If you walk into my office today, 2 things differ from what you would do 20 years ago. 20 years ago, you'd walk in, I'd lay out all the companies, I'd lay out all the plans. You and I would decide what you wanted. We'd write an application, we'd be done. Today, before you ever walk into my office, you have to go on healthcare.gov and set up an account. You have to feed that website a lot of information regarding your income, taxes, so on and so forth to determine where you're going to fit in the system. Then you come into my office. Then we look at your options, which are only 2, Medica and Wellmark Blue Cross Blue Shield. Trying to not get too technical, 20 years ago, I could offer you a HMO, a health maintenance organization, a PPO. I had options.
Dental, everything.
And all those, the PPO, HMO, and so on, simply determined how diverse your network was and what your coverage was going to be like when you went outside the state. Today on the marketplace, all that's available are HMO products. So if I'm an individual under age 65 buying individual health insurance today, not only in the state of Iowa, but anywhere, but particularly in the state of Iowa, I have 2 carriers to choose from, and I have to be satisfied with an HMO because that's all I can get.
Tell us what an HMO is again.
It's a health maintenance organization, and I'll use the 2 most common examples. You have what we become used to, an HMO and a PPO. We'll use Wellmark Blue Cross Blue Shield as an example. If I have a Wellmark Blue Cross Blue Shield PPO in the state of Iowa, roughly 99.8% of all the doctors and all the facilities, hospitals, clinics, so on and so forth, participate in that PPO. For that, and again, these numbers, I'm just using numbers to draw a comparison. If I'm in the PPO, I go to my doctor and I pay a copay, and maybe that copay is $30 to see that doctor. And I go to any doctor I want. And when I travel outside the state of Iowa, if I'm a snowbird or if I'm just going to see family, whatever the case might be, and I need health care, non-emergency health care, as long as I see a Blue Cross doctor in that state, it's treated as in-network just as if I were in the state of Iowa. Now on the HMO side, still have a network that's almost as deep as the PPO in the state of Iowa, but not quite. But it's a different contract that Wellmark has with those providers, so I get better benefits. If I'm willing to take the HMO, maybe my copay is only $20 in Iowa. But when I go outside the state of Iowa, I have emergency coverage only. So if I need routine medical care and it's not an emergency, I'm going to pay for it. That's the major difference.
What do most people have?
Most people want a PPO,
right?
Because they want that flexibility. Unless you have, let's face it, we have people who live in the state of Iowa, probably won't leave the state of Iowa unless family dictates it. And an HMO might suit them just fine because they just don't need the excess coverage. But most people want that PPO option, and they don't have it now in the marketplace.
So just as we get into healthcare, just briefly here, another reason to sit down with an insurance agent. How would you know all this stuff?
They don't.
I mean, the stuff you're talking to me, man, I briefly get into this with the company, but I mean, it's difficult. All the different plans, what they set them up for, Affordable Care Act, I kind of get it. But, and then, what are your options?
Well, if you think about it, one of the greatest advantages of the ACA supposedly was going to be choice. I can choose any company I want. I can do whatever I want. It's not true.
Right.
In the state of Iowa, you have a choice of 2. And that's
the only way they could make it, you have different selections, they'd have to force the companies to participate.
That's it. And that was one thing. And that's something they'll never be able to do.
Yeah, because they could go broke that way, I suppose. I don't know. Okay, well, so anyway, I guess my suggestion, not being in an insurance business, is you definitely would want to, whatever you're doing, is talk to an insurance professional.
You really have to. I mean,
how would you how even young or old? I don't care how old you are. I'm not even going to get into Medicare today. I'm not going to do that.
That's the easy one.
Yeah, no. Anyway, and that's a form of Affordable Care Act. I mean, the way I see it, just by being involved a couple of years, but
it is. Except in that situation, we've all been paying into the Medicare system
for our
years.
whole lives. But that's another story. Let's hit another area here at the end of our talk. Let's talk about disability insurance, because a lot of people don't understand it. And what's, in my world, just all you got to do is, insure his mouth, because all I do is talk, right? But I mean, from a business perspective or just from anybody, what is, tell us about disability insurance.
I think it's always been my opinion since the day I got in this, that disability insurance is not only the single most important insurance anyone should purchase, it's the most undersold coverage.
Really? Even more than medical?
Even more so.
Tell me why.
What's the most important asset you possess as an active, employable human being?
I don't know.
It's your ability to generate an income.
Yeah.
If you can't generate an income, you don't have anything. If you can't go out, imagine yourself.
What's the
look at where
probability of
you've
being
come.
disabled, though?
Well, look at over the last 20 years where you've come. What if 20 years ago you had a serious automobile accident or something that incapacitated you for the rest of your life?
There's
We
a
wouldn't be
value.
sitting here having this conversation.
Probably not. There's a definite value there. I get it.
It's huge. The advantage that most people have, fortunately, is that they work for an employer that provides coverage, and not all, but most employer-sponsored disability coverage that you see out there is decent coverage. It would compare favorably to what you can find in the individual marketplace.
So how much does it cost? Let's say you make $100,000 a year, and you're 30 years old. Roughly, what's that going to cost to have you pay? And does it pay a percentage of your $100,000 the rest of your life if you're permanently disabled, depending on how disabled you are? But how does all that go?
What I'm going to do, I'm going to cheat.
You're going to make it simple.
Yeah,
right?
I'm going to tell you.
I hope you are.
I'm not going to give you a specific number.
Come on.
It's too difficult because age.
You're not an actuary.
Occupation. Well, when you buy a disability policy, a white collar employee is going to pay more for the same coverage than a blue collar employee.
Why is that?
Relative risk. The risk of that white collar
not get
employee,
hurt or whatever.
and that's so. And age comes in.
Well, let's just make up a
It's
white
affordable.
collar 100,000.
I'm gonna say this: it's affordable, and I mean
20 a
that
month?
sincerely. Most people would find that they can incorporate something into their budget that's easily manageable.
Why is it undersold?
It's just the last thing anybody thinks about. And agents,
Because they don't think they're going to get hurt, or they're not going to be in a
or the assumption is that the employer is taking care of it for them, that type of thing. The typical plan, a good plan, will replace 60 to 66%, somewhere between 60 and 70% of income. It does it on a tax-free basis, provided the premium is not being tax deducted, used as a tax deduction. So most individual plans will be tax-free income. That's why the 60 or 70%. You can choose anything in between that you want. If you don't want to insure that full 60 or 70, you don't have to. So you can find something. And what we used to do in the early years, we would try and encourage people to buy enough disability to pay for the house payment, to pay for the things that had to be paid. And then just from that point on, it was up to them what they wanted to do.
It's a good point. Well, I think it's another type. And then lastly, let's talk about long-term care, since you and I are old men here.
You know, long-term care, plain and simple, in this day
expensive.
and age, you're probably looking at $60,000 a month for assisted living, full,
Not 60, 6,000.
or six. I'm sorry,
Yeah,
60,000
60.
a year.
Where are you at? I mean, you and
There's probably
your own
some,
eye.
depending on how
Yeah, I
nice
suppose
a
you could.
place you want, you could probably get there.
Wow. It's expensive to.
It's
to
very,
long-term.
you're probably
So-
looking on average at somewhere in the neighborhood of $200 a day, and it varies from location to location. But the point is this: at 60,000 a year,
right?
Depending on someone's financial status, net worth, liquid assets, that's a drain. And the thing that people forget about is you've got a couple. Today, we'll say they're living in retirement on $60,000 a year. Well, now one of them has to go to the nursing home. We've got $60,000 going out. We still have someone who's healthy and needs an income. So now our need suddenly went from 60,000 to maybe 90,000, 100,000.
So it's silly not to have some type of long-term care.
That's exactly
How
right.
expensive is it?
I would say on average right now, if I say age 60 to 75, a range of $300 to $500 a month will get you that 60,000 a year, or that 6,000.
So it's a dollar amount. It doesn't say where you have to go or whatnot. It just says we'll pay X amount for assisted living or whatever type of living.
Exactly.
Right?
Policies today are written in such a way that they basically take into consideration every potential type of long-term care that you might be looking at, be it home health care or in a facility.
Well, I think it's another reason I go back to having an insurance agent that you can sit and talk to, because even starting out as newly married, even as a single person, whatever your family status is, your whole life, children, as you get older, medical insurance, long-term care, disability, on and on and on, you definitely have a lot of reasons to navigate through all this stuff. So,
That's absolutely
I mean,
correct.
it's not as simple as you just go online. I don't think. I mean, of course, I don't go online for that kind of stuff anyway. But just go online and say, here it is, because there's so many family dynamics and personal dynamics with your situation, your estate planning, your everything that's going to affect it. So
It's the rare individual that can go online and
yeah,
navigate all of this and make all the right decisions. And in the end, what a lot of them end up doing anyway is picking up the telephone and eventually calling an agent and say, hey, this is what I did. How do I correct it?
in the last couple minutes here, Mike, talk a little bit about. I know you're in the stock market and you do a little bit of investments. Just give me your few 2 cents on the stock market over time. It seems like it's been 8 to 9% over the last 40, 50 years returns. It kind of dipped last year, but the 2 years prior to that, it was amazing. Just briefly, just real quickly, hit the stock market, which is another
Uh,
incredible avenue of investments.
just as a qualifier, so people know that they're talking to somebody that has a little bit of background. As you know, I had a small asset management company that I sold about 5 or 6 years ago. So it's interesting because when I did it, I thought the biggest relief, the burden off my shoulders is I don't have to go through another down market and make all those calls and explain to everybody what's happening and
Right.
what's going on. And truthfully, I look at this and I smile because we went through this in 2008.
Yeah.
We went through this in 2000. It as the old saying goes, this too will pass.
Right.
And I think what happened this time around though is we really really got spoiled. It was a long bull market, unlike we had
It was
seen.
10 years, right?
Oh yeah,
Or more. Wasn't
more
it?
than 10
Yeah.
years, and the returns were good,
Amazing.
and we all kind of got lulled to sleep, and we all knew it was just a matter of time before something caused a correction. And yet, if you think about it, we're still at
I
34,000.
know. Which
We
is
were at 36 when all this started, so it's not as bad as 2008. And it's the old saying that when there's blood on the streets, buy.
right.
Warren
Yeah.
Buffett. That's his famous mantra.
He's
And
buying. He's
he
been buying.
is. And
Yeah.
and all I would say to you here as we finish up is my question to people, and I've asked several people this: do you think Amazon's going to be here 10 years from now? Do you think Google's
Apple.
going to be here? Do you think Apple's going to be here? Do you think Microsoft is going to be here 10 years from now? Well, right now, you can buy them at bargain basement
That's right.
prices.
Right. Yeah.
They're all down 35 to 50%.
Right.
So, think
Another adage of the stock market: you just put it in and forget about it.
well, that's the other
I mean, you know what I mean? Some people that, obviously as day traders, people look at, we just put it in and forget about it and try to put something in every month. I would say if you had advice for young folks, I mean, in my world, they always taught me to be diversified, even though most of my assets are real estate. But that was wise advice I got about 30 years ago. Say, hey, watch, you got to do something in the stock market. And over time, you're right, it's a correction. But what you don't hear is the last few years, you're getting 20, 30, 40, 50% returns on a lot of stocks. They just talk about, well, it's down 20, 30% now. Yeah, but what did you make the last 10 years? You never hear that when people are talking about the stock market. But I think over time, I think it's 8 or 9%, which is a good solid return.
Oh gosh, yes.
A good solid steady return. And the other thing about the stock market, you're investing in American companies mostly. I mean, there's obviously foreign companies too, but you're investing in companies in the United States. That's how we live, eat, drink, sleep. We're investing in America. And it's like, look at John Deere stock. Have you looked at that lately? It's always been a great stock. And I like to, when I look at the stock market, I try to buy things. I like Lululemon stock. I like Lululemon. So I always got, I guess this isn't, but I should have wore a Lululemon top. But I mean, the companies you like Microsoft, Amazon, Apple products, if you like something, there was another adage, you got to buy the stock in the company because they're going to be here.
There's a story right here in Iowa City, and it's a great example of when you're buying quality. 30 years ago, I remember talking to some of the guys that unfortunately are not with us any longer, very successful in banking and so on. So, what are you doing with your money? Where are you putting your money? And all they kept telling me is, it's all in Procter and Gamble stock. It's all in Procter and Gamble stock. Well, how'd you do that? And well, they have programs you can do. So I got online and I looked to find out. I tried to find out how can I invest in Procter and Gamble stock without having to just hand over 10,000, 20, 30, 40, whatever. Well, lo and behold, they had a stock investment program for everyday people like you and me.
I didn't know that.
And I could put a monthly amount in, and every month it bought Procter and Gamble stock.
How's it done?
We did.
It's done
My
okay.
average rate of return on that, when I started that, Procter and Gamble stock was probably $30, $40 a share. Right now, I think it's 140 or something
split,
like that.
hasn't it?
It's split several times. It's gone down.
So-
Over the years, that has just been unbelievable. And as you just put earlier, I just forgot about it.
Everybody
If
needs
you-
a toothbrush, right?
You know, I'm still convinced that we make the investing in the market sound so complicated and so
Scary.
difficult. If you did a little bit of research and you found 10 companies who have paid a dividend every year for the last 25 years and have raised that dividend every year for the last 25 years, put an equal amount of money in all of them, put it in a drawer somewhere and forget about it, you'd be amazed in 10 to 20 years what that value would be.
Great. Well, good time. So I guess the moral of the story is there's a good bargain.
Oh,
Start
yes.
buying.
It's a good time to buy.
And then I'd say every month put something in. Then you dollar cost average. You're not all putting it at the end of the year, beginning of the year. Quit listening to CNBC every day, even though I like it. I mean, it's got some good stuff on it. But just put it in, and especially young folks, invest. Forget about it. Just make sure that you're putting in something monthly. So,
Well, yes, absolutely.
Mike, this has been great. Thank you so much for your time. I think the moral of the story is if you're getting into insurance of any kind, medical, disability, life, get with some local folks and talk to them. Get a good insurance agent and understand it, and increase your knowledge base. And then as far as the stock market goes, just put something in it and let it ride.
Save money.
And
That's all it
as
is.
you get old like we are, it starts to add up.
It starts to add up. You finally start to realize
make
what
it
it was
work,
all
yeah.
about.
Hey,
Thanks
great
a
to see
lot.
you.
I appreciate the opportunity, the invitation to come see you.
Always great to see you.